Today's my discussion topics is monetary and fiscal policy and the major difference between monetary and fiscal policy. What are the major consequences related to the monetary and fiscal policy, and why monetary and fiscal policy are connected to each others, and what are the major difference among them, and what are the implications on the national economy of monetary and fiscal policy. Uh, this section is very much important in finance and any types of economic sectors, and the basic knowledge of having these types of consequences like monetary policy and fiscal policy is very much important. So those who are new in this class, I think they can be learned some important things associated with national economy and the economic consequences. So, in my discussion of what will be the major topics, today's my discussion topics is monetary and fiscal policy, and what are the major difference between them, and why they are connected to each others. Why an economic policymaker or the central bank or the government can take into account for controlling the inflation or so on in an economy. So let's begin started to learn about these topics one by one. At first, we have to know what is monetary policy. In very simple language, if we want to say that monetary policy is a policy which is actually taken by the central bank of a nation to monitor its money supply in an economy. Then the new topics is coming towards us, that is money supply. What does it mean? We have to know the money supply, why it is related to the monetary policy, and central bank why are being too much uh, uh, think about this money supply, because money supply is the most powerful tools in an economy. It can make the economy exaggerated, disastrous, and so on. So keeping money supply in the actual level is too much important. So in general definition, we can say monetary policy is a one types of policy which is taken by the central bank to control the money supply in an economy. Okay, this is the basic consequences. Okay, then if we want to say about the fiscal policy, then what is fiscal policy? Fiscal policy is the another important policy which is also working for the controlling of money supply in an economy, but it is not doing by the central bank. It is actually doing by the government. They can make decision about how can they controlling the fiscal policy. The fiscal policy actually related to the government expenditure and income. The monetary policy aims to exaggerate or make the economic is not vulnerable. Okay, always try to make the economy in a position where the economy will run smoothly and the general people are being benefited from here. So conversely, by restricting spending and incentivizing savings, monetary policy can act a brake on inflation and other issues associated with an overheated economy. Then, in the bookish knowledge or the bookish definition of fiscal policy refers to the step that government take. Already I am saying that the fiscal policy actually taken by the government in order to influence the direction of an economy. Both fiscal policy and monetary policy are working for the direction of the economy, but rather than encouraging or restricting expenditure by business and customers, fiscal policy aims to together the total level of spending, the total composition of spending, or both the economy. The two widely used means that affecting the fiscal policy that already I said. The first one is the government expenses, and the second one is how can government earn this money. That one is the government taxes policy. So I would like to discuss about the first topics, that is monetary policy. Then monetary policy actually working for controlling various types of things, and also providing some important measures. That first one, if I want to say that monetary policy working for controlling the inflation, also it encourages to stimulate the employment in a nation. Okay, So there is a consequences that if we want to break down the inflation or keeping down or keeping low in inflation, then it is very much impossible to growing the employment in a nations, because we know that employment and the inflation are negatively related. Now the question is arising why they are negatively related. Okay, I can explain it in my general language. I think you can be understanding it. Okay. Actually, inflation, the new question is arising that what is inflation? Okay, so let's break down the inflation and the definition of inflation. In a general knowledge or general definition, we can say that inflation is a process, or inflation is a moment or is a consequences where the buying power of money is decreasing, as well as the general price level of the goods and services are being increasing. So what can we say? We can say that the power of money is being decreased, but the general price level is being increased. A definition, this is the definition. And if I want to give an example, that is I say that 2 years earlier you may buy a single pen by using 5 taka, okay, but after 2 years later, right, this times you may buy this same pen using 6 taka. What does it mean? It means that the pen is same, its quality is not being changed. This is a pen, only pen, okay, but 2 years earlier you may buy this pen by using only 5 taka, but now no change in its condition, no change in its manufacturing cost, no change in its production, or no change in its quality, but the general prices of these goods is being increased by 1 taka. So what can we say? We can say that the thing is same, but the price level is being increased. So it can be said that inflation, okay, there are many reasons for inflation, there are many consequences of inflation. So why inflation is being increased? Why inflation? Now the question is why inflation. Actually, I am starting my discussion from monetary policy. Then I am told about that monetary policy actually working for controlling the inflation. Then I am discussing about inflation. Now the question is why inflation? Why inflation is occurring? And I also linked between the inflation and employment. Just recognize it. I can connect everything one by one. Okay. Okay. Let's start. So why inflation? Actually, inflation is occurred when the purchasing power of the general people are being increased. Okay. The purchasing power of the general people are being increased. For that reason, the inflation is occurred. When? Now the question is when the purchasing power of the general people is increased. This is the main important question, that when actually the purchasing power of the general people are being increased. The main topics or the main consequences is that when the general people have adequate money, and they have adequate money to buying goods and services, and they are going to the market and buying their favorite things or favorite goods or so on. Now the question is from where they can get the adequate money. Just link that they can get adequate money by their employment. A general people like me do not do anything. After I am getting employed in a company, in a bank, or any financial institutions, I can get my salary after 1 month or after 2 months or so on after times. And when I am getting cash, then my demand is increasing. So I am going to the market and my solvency is increasing. So my demand already increased and I am trying to buy something, so that when in an economy employment level is increasing, the general people buying power is also increasing, so that they are going to the market and buying their desired good, and the demand for these types of goods and services also be increased. When the demand for a goods is increased, the general consequences is that the general price is also is increased. So clear it is? Okay, it is very much clear, I think. that when inflation is also increasing, it's also increasing for the reason of increasing the employment. So I can say that the controlling inflation and employment is not possible in at one time. So you have to consider some types of inflation or some inflation when you actually want to increasing the general people buying power or general people solvency, or you may want to make them employed. So if we want to say that in an economy the every people are being employed, it is not being possible, because when every people are being employed, actually it is not possible. But when they are all being employed, but they this increase the inflation, and inflation is not good for an economy. But at a level you should have considered the inflation at a level, but after that this is disastrous for an economy. So monetary policy actually working for the trade-off between the inflation and the employment. If you want to decrease the inflation is too much low, then employment level also being down, then the economy fall in a situation that general people have not adequate money and they are fall in disastrous situation. So you have to try, or you have to maintain or trade off at a level where there is a actual or adequate level of employment and there is an inflation. So I think it is clear to you. Okay. The first topics is already I discussed, that monetary policy working for the controlling of inflation, and then I will connect the inflation and the employment level and why they are connected to each other and what will be the next consequences I already discussed. Then I want to say most important topics, that interest rate, because it is related to each others, because interest rate is also related to the inflation, is also related to the employment, is also related to the government expenditure and so on, and the general people consequences on it. In the government, when increasing the interest rate of the bank, the general people are most likely want to savings their fund, their money in the bank, because they get high interest from it. As a result, when interest rate is increasing, the level of investment is going down. Why? Because before interest rate is increasing, the investors get loan from their bank at a low interest cost rate. So when it is increasing, the investors are not being inspired to get loan from the bank. So in this situation, the general people are being getting benefited, and it is also an important policy of the government or the central bank to control the inflation. How they can control the inflation? When the interest rate is increasing, the investors are not being influenced or being interested to getting loan from the bank. So it indicates that the money supply on the economy are being decreased, and on the general people side they are being encouraged to savings their money from the bank, because they get high interest rate, they get interest back, and interest after 1 month or 2 months they get interest, and they are doing their day-to-day consumption or investment level. But the general money supply of an economy are being decreased. So it is an important policy of the central bank to provide adequate money in an economy or controlling the money supply of an economy. So it is clear to you, I think. There are also some important thing which is associated with monetary policy, but I am not going on this side. I would like to now telling about something about the government fiscal policy. Okay. Actually, I want to tell you that what are the difference and why monetary policy and fiscal policy are so much are closely related to each other. Okay. I think you will link in these topics one by one. Okay, now the next topic is fiscal policy. Already I am telling about that the fiscal policy. Fiscal policy is taken by the government to increase the amount of the money or making the economy is much more going on and so on. Okay. Now, how the government can influence the money supply of an economy, okay, or how can the government can influence the tax policy of an economy when the government wants to decrease the money supply of an economy or make the contraction of the money supply in an economy, they can increasing the general tax rate. Okay, now we have to know what is tax. Tax tax is a levy payable to the government, and it is compulsory. It is must be compulsory to those people to have adequate income level. After that, they must be paid taxes to the government, and it is their legal responsibility as a citizen to paying the tax, because without tax the government cannot going on smoothly. So you have to pay tax after you have the adequate money. Okay, so and another important thing is that tax is a levy payable to the government, and you cannot expect getting back from the government. That if we going to the market and buying some things by using our money, then we can pay 100 taka to the shopkeeper and they give us a thing or services. But in the context of tax, it is not so on. Okay, you have to pay, but you did not deserve to getting back something from the government. This is the most important thing. Okay, now when the government actually wants to contraction the money supply of an economy, they actually increase the tax rate. We know that there is a two types of tax: direct tax and indirect tax. Okay, what is direct tax? Actually, direct tax is related to those parties or those persons those who have the adequate income level. This is not payable to the everyone. Okay, and indirect tax, this is the most important tax, and from where the government can earn huge amounts. Okay, indirect tax is the one type of tax which is payable to the every person. A newborn baby also need to buying indirect tax. Okay, if you want to buy a single pen, a single chocolate, you have to pay indirect tax. But direct tax is imposed only to those persons those have the adequate income level. Okay, so when a government wants to contraction the money supply of an economy, then they can impose high tax rate. Sometimes they can increase indirect tax rate, sometimes they can increase direct tax rate. But which one is much most preferable? This is actually depends on the economic condition of a nation or the political condition of a nation and so on. So it's a country to country or economy varies that which tax actually want to increase by the government. Yeah. Very much important things we already learned that by using taxes or tax rate, the government can control the money supply of an economy. And the second one is government expenditure. Sometimes and government must do expenditure for their services and so on and so kinds of things. So government expenditure is also an important thing. Government sometimes provides subsidies to the parties, those who are actually wants to invest their funds in a big corporation or big company or making their business profitable. So this is the most important things. And if we want to say that the main difference between monetary policy and fiscal policy, that one is controlled by the central bank and another is controlled by the government monetary policy issue agency or so. And the main objectives of both of them are closely related to each other, because both of them are want to control the money supply of an economy, and they are want to make the economy much more profitable and growing down, and they are actually working for the increasing the GDP or growth rate of an economy, and wants to control the inflation, and wants to increasing the employment rate, and wants to break down the vicious circle of poverty, wants to increase the purchasing power parity of money, wants to increase the international relationship with them, wants to increase the life standards of the general people, and wants to increase the political, social, economical, and so on things. As a result, we can say that both of the things are must for an economy. And we have to learn in these topics because these topics is closely related to the economy. I think This topic is very much clear to you. I am trying to my best to learn these topics very clearly, and I have some lags, so don't take it seriously. But you have to take the actual things that I actually want to deliver to you. Thank you very much. Thank you for your concentration. Thank you.